Hey everyone, this is Victory's virtual workshop, creating confidence and clarity for your financial life. And today we'll be reviewing the third quarter of 2024. Man, that sure came up quick, with a short slide presentation courtesy of our friends at JP Morgan Research. Now, if you have any questions about the material I'm going to present, please reach out to Patrick at victoryindependentplanning.com, or you can channel your inner millennial and text me at 239-567-5477. Okay, let's get started. So a fair amount has happened since we last checked in on the economy at the end of Q2, things like rising interest rates and global political issues. So let's get to the charts and see what we can see. Let's start with economic growth and how it's broken down inside of GDP, at least in the United States. On the left side of this page, you'll see the chart displaying real GDP in dollars over recent years. Well, after the US saw a quick recovery in 2021 following the pandemic, growth has since normalized, and it remains fairly resilient. Moving to the right, we have the most recent GDP breakdown, where we see that consumption is still the largest driver of the economy. And it's held up quite well throughout the year, way better than I thought it would, with rates rising so fast in 2023. And you'll note that when you go to the right side of the chart on the left, we've actually made a slight move above trend growth, which is fairly impressive, I have to say. What's not impressive are federal finances and the deficit. Indeed, there was a Wall Street Journal article just this morning saying that now that the election is at hand, people are actually paying attention to the deficit again, and that may be a cause for volatility in the future. My question is, where have you been all this time? Here we have a federal deficit and debt projections, with the left side showing spending plans for fiscal year 2024, noting that net interest on debt is becoming a growing expense. Duh, interest rates are up. That means debt is more expensive. On the top right, you'll see the federal budget surplus and deficit as a percentage of GDP, highlighting that rapid growth in net interest expense. Now, those projections, which are already kind of eye-watering, do not yet account for possible tax cuts and Jobs Act extension. But if passed, it would significantly increase future deficits. That's not a partisan statement. That's just a fact. You can't have the amount of spending that we have and keep tax rates where they are and not run into an issue. So below that, on the right-hand side, federal net debt as a percent of GDP is forecasted now out to 2034, with interest rates and economic assumptions shown on the bottom left. Notice that federal net debt is scheduled to exceed 100% of GDP and then go as far as 131% of GDP by 2034. That is far and away the highest our debt has been as a percentage of GDP, including during World War II. Next up, unemployment and wages. We're looking at the labor market here. And this slide provides unemployment rates and wage growth trends since the 1960s. And historically, these measures have had an inverse relationship. They act opposite of each other. After a strong 2022, the labor market is cooling. You remember, we had unemployment rates around 3% previously, and now they're hovering closer to 4%. That's a cooling trend, with unemployment ticking up slightly. But most of this is due to increased labor participation than layoffs. That means more people are coming back into or are getting into the workplace to begin with than are leaving it. And that would help moderate wage growth as the economy slows, meaning that this is not necessarily an inflationary issue. And what you see is that the decent labor market is allowing personal balance sheets to remain relatively strong. Certainly better looking than the federal balance sheet, which looks terrible. This actually looks okay, with 66% of household level debt being in long-term mortgages that are backed by an asset. So that's a relatively good thing to see. What's also good is up on the upper right-hand side, you'll see household debt service ratio. And those debt service ratios are higher over the last couple of years, but still much lower than we saw in most of the 3 decades before COVID. All right, let's talk a little bit about markets, annual returns and intra-year declines. Now, this slide illustrates the volatility within annual stock market returns, and the red dots mark the lowest intra-year drops, while the gray bars show the year-end performance. And the trend shows that even after downturns, often in years where there are downturns, major downturns, markets rebound by year's end, most times. Certainly that's not a universal. But it is an encouraging message for an investor who knows they need to stay patient through a fair amount of market turbulence. And given that we're about a week out from the election, that kind of turbulence could be on the horizon. Note that year to date, although the market has had an 8% decline, it's up about 21%. Last year was about the same. It had a 10% intra-year decline and finished up 24. Even in years previously, like 2020, where the market was down as much as 34%, it tended to rally back and was up 16. So what does that mean? Well, it doesn't mean anything, but it should give you an idea that even when markets decline, that doesn't mean the year is completely lost. On to global equity markets. So on this page, we're diving into international equity markets, and that top right chart shows how Japan used to dominate the MSCI All Country World Index. If you're as old as I am or older, you remember a time when China was not the major global economic fear of Americans. It was Japan. The Japanese were coming over here in the 80s, and they were buying everything, including auto plants and in real estate. So this is a good reminder that that these things are cyclical. Today, U.S. equity has taken the lead on the MSCI world, and that could signal some possible overvaluation. We've talked about this in previous quarter reviews, that international continues to look more and more attractive as the dollar remains strong and probably is overvalued, as well as U.S. equities probably being overvalued, which we'll talk about here in a minute. The bottom right chart, that's going to break down where different regions derive their revenue, illustrating that the UK and European companies, for example, have fairly diverse revenue sources, right? Which is a good thing for those countries, especially if we're headed towards an economic slowdown globally, not a recession, but even just a slowdown. You want that diversification. So we may be looking at more and more foreign investments and looking at more and more diversification as time goes on. Again, we'll talk about that in a second when we discuss what's gone on with what's called the Magnificent Seven here in the US. That big table on the left showing currency returns across indices, and it's emphasizing the importance of currency effects on returns. You can see that in the difference between local returns and US dollar returns. With the US dollar being so strong, it tends to depress potentially some of the returns of foreign assets. And if that were to swap, if the dollar were to become less of a factor, you might be looking at a new renaissance for foreign stocks. Not a prediction, just a point of interest. Okay, global equity earnings and valuations. Here we're examining earnings growth and valuations globally. On the left, we see that international earnings outpaced U.S. growth from 2000 to 2007. But US earnings have now led from 2007 to 2023. That's a long time for that type of dominance by the US. On the right, we compare valuations in various regions with 25-year averages and early 2024 levels. Now, this could indicate, again, a turning point where international markets may begin to offer more growth potential and at more attractive valuations, something we are certainly keeping an eye on. Now, here we focus on the S&P 500 valuation using a table and a 30-year history of the forward price to earnings ratio. And what we're assessing here is the market's valuation level compared to historical averages. And we can see that today's market may be overvalued. Okay. What does that mean? Overvalued. If you watch MSNBC, CNBC, and again, I don't recommend doing that for entertainment purposes only, I suppose. They're going to talk about valuations. They're going to talk about the market being overvalued. But what does that really mean? Typically, what it means is that in a growth phase like we've been in, investors are buying future earnings now. They're pulling in those earnings and buying them now to lock them in. And that may indicate, as you can see, us being quote unquote overvalued, not necessarily collapse in stock prices, because to get back to average, earnings could go up or prices could come down, or there could be a combination of the two. But what we're really talking about here is, not the market collapsing, but we're talking about this price to earnings ratio normalizing. So yeah, maybe you get a little bit of a sell-off in certain parts of the market. Maybe you also get better earnings than are estimated, and that price to earnings level comes down. What you also might be seeing here is a rotation where these stocks that are the major growth items, the major growth stocks, the ones in technology and AI, those are the ones with the sky-high valuations where people are pulling in future earnings. And maybe those are now ready, like we think we've been seeing for the last 6 months or so, ready to turn over leadership of the market. And again, you'll see that average price to earnings ratio start to decline. The other thing that we could see here, because of what we're saying are larger than average or larger than normal valuations, we could just see a quieting of the market, right? We just saw in a previous chart that we've had back-to-back 20% years in the S&P 500. Well, maybe we're due or overdue for a 4 or 5% year, or a flat year, or a slightly negative year, or a slightly positive year. My point is that there are ways to get out of this overvalued portion of the calendar in the stock market that don't require a huge correction or a bear market. Let's talk about yield curve dynamics here. And this has been important over the process of 2024. Here we have the US yield curve at different stages. And as the Fed raised rates in 2022 and into 2023, the curve inverted sharply. So you were actually getting paid more to own short-term instruments versus long-term instruments. That's an inversion. And now as rates stabilize and start to decline, the yield curve is normalizing very slightly. You can see that a 5-year will get you 3.6% and a 30-year will get you 4.1%. That's not a huge steep yield curve, but it is a normalized yield curve. So we continue to monitor the 2 and 10-year yield spread, which should continue to give us some insights into what is ahead, both for interest rates, which, my personal belief is that the Fed controls the short end of this curve, and they are going to be, trying to get that short end down to decrease short-term rates to normalize the entire yield curve. So you may see long-term rates actually start to go up a little bit and short-term rates continue to decline. And that would actually be healthy and be a normal yield curve, something we haven't had in quite a few years. What does that mean for interest rate expectations? Well, the federal funds rate history and market expectations are shown on this page. And the shaded area represents market outlooks since the December 2023 FOMC meeting. Okay, that's the Fed's Open Market Committee meeting. And on the top right, we see FOMC economic projections for the next few years with long-run estimates to provide context. But what's always been interesting to me is the Fed has been saying that GDP would continue to run at about 2%. And they've said that the unemployment rate would continue to be about 4.4%, but that core inflation would decline in 2025 and 2026. And I'm not sure that that's correct. I think that there are some errors in these projections that may or may not come back to be an issue later on. But that's one that I monitor. If you're going to have continued economic strength and continued unemployment, that's relatively low, you're going to have a tougher time getting back to the Fed's goal of 2% inflation than I think that they've counted in. Next, let's look at fixed income, which was kind of left out for really about a decade. I can remember after 07, 08, when interest rates went to zero, we didn't really talk about fixed income because it wasn't attractive. When you're getting next to zero on your investment from the interest payments, that not only makes it less attractive, it also makes it more volatile. So fixed income was an area that we treaded very carefully in, really since I started doing this on my own in 2010. So what this is showing you here is how certain bond instruments would react with different interest rates occurring. So if interest rates went up by 1% or if they went down by 1%, what would these particular instruments look like? And you can see the lowest volatility instruments are really under the 5-year US Treasury, right? Once you get outside the 5-year US Treasury, you've got some volatility if interest rates change. You could make money if interest rates went down, but you could also lose money if interest rates went up. Now, what's interesting is these numbers are nowhere near what they were 3 or 4 years ago, right? Because as interest rates have come up, it's made this market less volatile, which is a good thing. Now, yeah, you can still lose potentially 21%. You could potentially lose 13% on a 30-year US Treasury, but that was in the mid-20s a few years ago. So this is actually a positive development. It's good to see interest rates coming up and normalizing. And as that curve normalizes even further, it's actually going to make the bond market less volatile. Fingers crossed. The Magnificent Seven, that is the top 7 performing stocks, mostly driven by AI, really since 2023. In 2023, these 7 stocks contributed most, if not all, of the positive return, depending on how you measured it, inside the S&P 500. But they also weighed heavily on the negative performance in 2022. And that's the piece that, again, if you're watching CNBC, which I don't recommend, they're not talking about the losses that you incurred before you saw the gains in 2023 and even into 2024. But why? Why are those 7 stocks, or have those 7 stocks been so key to the market success? It's been earnings. And I know that that's not necessarily a popular way to look at things, but it's the correct way. These companies were making money in 2023 hand over fist. And you saw that reflected in their share price. Are they getting overvalued now? Probably, because they do have business models that should continue to earn money. And as I said, investors are willing to bet on those future returns, those future earnings, and that creates more buying now to pull in those future earnings. So yes, they may be overvalued, and that is okay. That doesn't mean I would recommend putting all your money in the Magnificent Seven right now, only if you have a time machine, which most of us do not. So this could be a good thing because as the Mag 7 gets overvalued, it's going to make other companies more attractive, especially companies that have slowly been improving their own balance sheets and are now making money as well, on par with what the Magnificent Seven was doing maybe a year or 18 months ago. To that end, let's take a look at CD rates and investment alternatives. What we're doing here is comparing CD rates from the past rate hiking cycles. So we're now, through our rate hike cycle, and we're actually starting to cut rates again. But in other rate hiking cycles, when rates got to their peak, we want to show what CD yields look like afterwards. Because right now, as they've peaked, they're pretty darn attractive. But as the Fed has lowered the short-term interest rate, they're going to potentially underperform other asset classes over the next 12 months, 16 months, 24 months. Why? Because those rates are going to decline. And as we just saw, the fixed income market or the bond market should continue to strengthen, get healthier, and less volatile over time. And that means you might have the potential to start cycling out of these short-term CD rates and even eventually T-bills to invest in more fixed income. Okay. I'm not saying that's going to happen today, but that is something that should be on the radar because the CD, the T-bill, that renaissance is starting to decline, and obviously it's not going to last forever. Market returns and Fed cutting cycles. So kind of to the point of the previous slide, we're reviewing here market performance around Fed's rate cutting cycles. And as rates come down, we see on the left that equity market returns, and on the right, fixed income returns, those returns around these cycles usually have a pretty good recovery pattern. So what we think here is that, fixed income, especially there on the right, you're looking at a 10-year return around the start, or 10-year U.S. Treasury returns around the start of Fed cutting cycles out to 24 months. Those are pretty decent returns, especially for fixed income. On the left, it's more of a mixed bag. Stocks can do very well over the next 24 months after a rate cut occurs. But you see the 01 and 07 outliers there. Important to remember what was going on during those periods. You had massive financial shocks, which were the reason for the rate cuts, versus now, which the soft landing scenario is the reason for the rate cut. So, all in all, thinking that this looks pretty accommodative for both stocks and bonds going forward. Does that mean huge returns? No. Just said at the beginning of this, I think things are bound to moderate, but that is okay. So as we get into the end of the year, there's plenty of opportunity for geopolitical events to shake things up as the year draws to a close. But big shakeups in markets over geopolitics tend to be outliers. They tend to be outliers. The average downturn, and looking at the chart here, is 12 days, just over 5%, with 13 days to recover due to a geopolitical shock. Now, the major exception would be the oil embargo of the early 1970s. Now, given what's going on in Iran right now, could that happen again? I don't think so. It's probably not likely, as the production of energy resources has diversified significantly since the early 70s. Whether you know it or not, America now is a net energy exporter, has been since the early days of the 2020s. Most of that's liquid natural gas, but the point is energy resources are significantly more diversified than they were in the early 1970s. So if you're worried about geopolitics, I get it. I'm not going to tell you not to worry about conflict regions, but just know that the effect on your portfolio in most cases is relatively subdued. Let's wrap up with the economic scorecard for late 2024. And I know this chart's very difficult to read, and I'm not going to leave it on there long enough for everybody to read through it. So if you want a copy of these slides, please reach out to me, and I'll certainly send you one. But the idea here in general is that the U.S. economy grew at a 3% annualized rate in the second quarter. It's looking on track to do that again in the third quarter. Had robust consumer demand driving growth and spending, which increased by 2.8%. And despite some slowing data hinting at possible recession sometime in the future, the risk of a severe downturn remains fairly low due to stable cyclical sectors, moderate consumer spending, as well as the inflation data coming down and corporate profits remaining fairly robust, especially outside of that Mag 7 group. We're actually starting to see those earnings become more and more enticing, which is a great sign going forward. Corporate earnings were strong in Q2 and Q3. Back then in Q2, earnings were up 11% year over year, and broader economic moderation is expected to continue supporting those corporate earnings. And inflation's on track to meet the Fed's 2% target potentially next year. Again, I think it's going to take them a little bit longer to get to that target than they think. A lot of the data, a lot of the research suggests that once you've blown through 2%, it's a lot harder to get back to it than you think, but we'll see. Meanwhile, the Federal Reserve has begun to cut rates. That should support the economy, and it's aiming to support the labor market as well. And more gradual cuts are planned through the end of 2024 and into 2025. Are there risks? Of course there are. Geopolitical tensions, which we mentioned, the next week to 10 days or longer with the U.S. election could certainly add some volatility and some unknowns. But right now, we've got a fairly impressive start on what the Fed has called a soft landing as far as the economy is concerned. I didn't think it was going to work out this way. I'm on record as saying we were probably going to have a recession sometime this year. But as things stand now, I'll happily admit that I was wrong. Fixed income looks good. Diversified international markets may offer us some opportunities amidst those broader economic uncertainties and growth outside the Magnificent Seven. So hang in there, folks, and we'll see how the fourth quarter plays out. Now, what does all this mean to you? Well, consider it a gentle reminder to make sure you are doing all of this correctly. And that means you should make sure your investment planning is up to date. If you haven't updated your risk preference and your risk tolerance, now is a good time. And there's a link to do that in the comments to this video. Remember that being on glide path towards retirement or before retirement starts with a smart approach. Make sure that your sources of income and savings, medical and healthcare planning, advanced planning, risk and investment management, and tax-efficient strategies are all working together. If they aren't, well, we risk taking too much risk or potentially leaving money on the table. If you're not feeling like you're on a smart path in or towards retirement, please get in touch. Thanks for tuning in. Have a great holiday season, and we'll talk to you at the end of Q4.